Well, welcome everyone to the Brian Crombie Radio Hour on Saga 960. I really wanted to focus on how difficult it is for companies to be raising money during COVID-19. And a week ago, I was honored to be included in a conversation that took place that was moderated by Caitriona Geoghegan, who is a very senior person at National Bank of Canada. She did a spectacular job, and I wanted to invite her in today to talk about what it's like right now for companies that need money, that are accessing the debt or equity markets. Caitriona is head of the lending in the National Client Group for Central and Western Canada for National Bank. She leads a team of relationship directors and credit underwriters focused on providing financing to large private and small cap companies across many different industries. She's got over 13 years of experience in Canada, the US, and interesting enough, Ireland. And that's why I've got difficulty pronouncing her name. Caitriona, thank you so much for joining us tonight.
Thank you so much, Brian, for having me. It's a pleasure to be here.
My pleasure to meet you again. So tell me, what is it exactly that you do?
So I lead a team of, you did a great job in explaining high level, but so I lead a team of people, both credit underwriters and deal originators in the, call it mid-market corporate banking, commercial banking space. And I'm actually part of this interesting team, which it's fairly newly put together, actually. It's in National Bank's National Client Group for Central and Western Canada. And it's part of this new initiative whereby National Bank is seeking to really ramp up and grow its presence outside of the Quebec market. So to me, it was a really interesting opportunity. And I actually just came over to National Bank back in the end of 2019. And we've been really beefing up and growing the team and establishing our presence since then. So it's been really great. We lead this integrated team. So I mentioned that I'm the head of the lending group, but outside of that, we've also got capabilities in M&A investment banking, private banking, and risk management solutions and derivative products as well. So we have this whole go-to-market strategy where we can really offer all aspects of the bank to our clients. And so it's been working really well so far. And we've really put together a fantastic group of people to work on the team, and we're very ready to service the market, and it's been going really well so far.
Excellent. Well, congratulations. Sounds like you cover a lot of different companies. What industries have been most affected by COVID-19 so far?
Yeah, I mean, I think it's not going to come as a surprise to say that the likes of, transportation, hospitality, retail, oil and gas, those types of industries are the ones that have been most impacted from a negative perspective, for sure. But outside of that, every single company that we're dealing with across the country and internationally are being impacted by COVID in one way or another. And, some of the companies are actually being impacted positively. When you look at stuff like food retail or food delivery or office supply companies, things that have really been, where customers are spending during the COVID period and lockdown. On a general basis, all of our companies spent a lot of time firefighting over the first couple of weeks and really trying to figure out how to operationalize things. Some of the industries that were really interesting and pivoting were, stuff like the restaurant space. They had to pivot away from in-restaurant dining to now curbside pickup and ramping up the online delivery and stuff like that. Retail obviously was super impacted, and they had their complete channel shut down from a bricks and mortar standpoint, so they had to really beef up their online presence as well. And I guess a lot of companies across the manufacturing and factory type positions as well have really had to try and figure out how to make sure the safety of their employees was continuing to be taken care of, because that really meant that they were going to be able to continue operating. And one of the industries that comes to mind in particular from that perspective would be the meat processing industry, which got extremely impacted, as you know, back in the last couple of months because of COVID, just given the close proximity that people have had to work together. So lots of these companies have had to put in place measures for personal protective equipment, even temperature checking on the way in, and in order to really try and make sure that the operations are continuing. And I guess across the board, almost every company that I know has had to have a lot of people go and work from home. So from a technology standpoint, a lot of companies have had to really figure out, how do we get people working from home remotely? How do we get equipment sent to them? How do we operationalize this? And I think people have done such a great job on that, that actually we're probably going to see a lot of people and a lot of companies switching over to this on a more permanent basis. And we've seen some companies come out and say that they're going to do this for sure, a lot of them in the tech space. But I think outside of that, a lot of companies are seeing how productive and efficient people can be in working from home. And especially as we reopen the economy and see how social distancing impacts, getting into work on a daily basis and trying to interact, I think we'll probably start to see a lot more, work from home across the board as well.
What are management teams focusing on? What are they calling you about?
Management teams are very focused on, well, first off, it was how to actually continue operating. But secondly, I think definitely liquidity is a super, top of mind topic for most of our management teams that we're working with. And when you talk about liquidity and you're talking about how do we manage liquidity in a situation like this, companies have had to really sit down and really sit down and understand what the budgeting process looks like over the next couple of weeks and months. They've had to cut expenses. They've cut, numbers of employees. They've put some employees on furlough. They've managed through, cutting CapEx numbers. They've managed through cutting down on non-essential type spending, including sometimes advertising, sometimes non-essential travel and things like that. And, they've really had to work with the banks in terms of seeing what that working capital forecast looked like. A lot of companies, this was a very different situation to most recessions that we have seen in the past, where we were coming from a very stable and strong economy. And a lot of our clients that we're dealing with, at least, have entered into this with a fairly robust and strong capital balance sheet position. And so a lot of companies were able to draw down on their credit facilities in order to make sure that they had lots of liquidity in place. And, even some companies as well, in spite of the fact that they've had really a complete shutdown of their business with close to zero revenue coming in, some of those have a very long cash burn forecast because of the fact that they had sufficient liquidity on hand. And some of them as well, I think, have been focused on understanding like the variable cost structure of their business so that they can, ensure that they're able to whittle that down in line with what the demand for their product has been as well.
Right, for sure. We're chatting tonight with Caitriona Geoghegan. She's with National Bank. We're talking about companies, COVID-19 and banks and financing. We're going to take a break for messages. Stay with us. Welcome back to the Brian Crombie Radio Hour. We're chatting tonight with Caitriona Geoghegan. She is with National Bank, where she leads a group that lend money to a diversified group of private companies and small cap companies in diversified industries. And I wanted to access her knowledge about what's going on in the bank market today and the corporate market today with COVID-19. Caitriona, tell me, when companies are coming to you, what are they asking the bank for, and what is the bank prepared to do?
Yeah, I think that the banks are super supportive of clients as we've been continuing to navigate through COVID-19. Mainly, I think what you can see the banks doing these days is payment deferrals for business and corporate clients that, are running out of liquidity. There's, provision of liquidity both through the bank's own means as well as through some of the government support programs that exist through the BCAP program in association with the EDCs and BDCs of the world. And then outside of that, which is a really large part of what we're doing on a daily basis, is working through covenant amendments. And so when you look at the types of transactions that we work with our clients on, they're cash flow based deals. And those cash flow based deals have cash flow based covenants in place in order to govern the credit agreement when it gets put into place. And so with the decline in performance, a lot of companies are coming to us and saying, we're going to run into an issue because our EBITDA has declined as a result of COVID. This is something that mainly wasn't an issue for many companies for Q1 because COVID started to impact in mid-March, which is the back end of the first quarter. And so unless a company was really struggling in advance of that period, they were probably fine for Q1, but it's from Q2 and Q3 calendar quarter onwards where, we've seen companies run into challenges in terms of covenants. And so, we've spent a lot of time over the past few months and with other banks as well. I mean, we all work on deals together for large financings where we lead or another bank leads. And so we're seeing this consistently across the entire portfolio of all of the banks. So, that's something that people have been very, very involved with in doing over the last few weeks and months. I would say we're expecting to see a second wave of covenant amendment requests come through within the next few months as well, because mostly we've done this on a short-term basis because nobody knows what's going to happen over the next 2, 3, 4 quarters, right? So
Yep.
that is something that we fully expect to see happening. And I think as well, outside of those items, we on my team, at least anyway, have been really involved and in proactively helping our clients to manage through the situation, whether that's, providing advice. We've pulled together loads of intel around the government support programs to try and help companies to navigate through that. We share lots of economic intel from our chief economist. We share intel from our investment banking and M&A teams and what's happening out there in the market. And, really just staying in front of our clients, helping them to manage through. And they help us as well, because as I say, we cover a diversified group of industries. And for us, knowledge is key in trying to manage through this situation. And so we're getting intel on every single call, and it's back-to-back calls every day. So that open communication has really been, something that's very helpful in terms of navigating through.
And just practically, I presume you've been working from home as well?
Yes, working from home. Myself and my husband, he works in the basement and I work in the upstairs, and our dog, and we have 2 dogs right now actually, running around the house barking. So I'm constantly trying to manage the calls to mute when the dogs start barking.
So I've been surprised at how many companies I've seen that have issued commercial paper, or drawn on their credit lines, et cetera. Are a lot of companies sort of maximizing the amount of cash they're just holding?
Yeah, absolutely. And, I think going back to the point earlier around the fact that, we didn't enter into this and it wasn't like a long-term lead into a recession like we would usually see. So lots of companies came into this from the perspective of, being in a good liquidity position. And most companies wouldn't have built up that cash buffer or, had those credit facilities put into place for the purposes of navigating through COVID. They would have done that in order to manage through, whatever types of projects that they had in mind. And, probably some organic growth, some projects, some, acquisitive stuff. But that has definitely helped a lot of companies in terms of navigating through for a short-term period, at least. I mean, lots of companies, especially on the smaller side, if this continues to go on for much, much longer, there's definitely going to be different implications. But for now, that has been something that we've seen help companies to manage through for sure.
I'll bore you with a quick story. I was a treasurer of a company at one point in time, and I was dealing with an investment banker at RBC Dominion Securities, and we were debating whether we should issue the cash, whether we should issue some equity to get cash at the time, and we didn't need it. And he said that when he was just a young investment banker in the 1950s, a senior banker took him aside and said, "You know what? When the tea cart comes down the hallway and they offer you tea, take the tea, because you never know when the tea cart's going to come by again." And he said, the one job a treasurer can never risk, Brian, is running out of cash. So if you've got an opportunity to get cash at a good price, get the cash. That story always stuck with me. And, in Finance 101, you always learned that when you head into a bad time, you want to have lots of cash in your jeans. So
absolutely,
that one of the rules you would tell people?
Well, I mean, yes, of course. I think that a lot of the companies that we deal with have lots of sophistication in terms of their management teams, and people definitely have the understanding around that. I mean, we definitely help our clients in terms of navigating through all of these situations, and I mean, absolutely, cash is king, and liquidity is for sure the number one thing on top of C-suite executives' minds as we continue to navigate through this.
The Canadian banks reported recently, and there were a lot of losses. Should we get worried?
Should we get more, you think?
Should we get worried?
Should we get worried? Yeah, I mean, definitely the banks have taken huge loan loss provisions this quarter. And I think, they followed what happened in the US and internationally, of course, in the preceding couple of weeks before the Canadian banks reported. We reported a little bit after. And I think across the big 6, there were over 10 billion in provisions taken this quarter. Not surprising. I think everybody had expected that. And these are future provisions for future potential loan losses coming out of COVID. I think most of the banks are saying that they're, taking provisions very conservatively and taking as large a provisions as they can. In spite of these huge provisions, some of the banks and, quite a few of the banks have still maintained profitability in line with, analyst consensus, because some of the other divisions within these banks are able to withstand, there's a lot of volatility in the market, so that drives a lot of derivative and trading type business for the banks, and as well as that, there's a lot of advisory work that's happening as well now. So those things have kind of helped to prop things up. In terms of the tangible impact and what that looks like going forward for the banks, whether they actually realize these losses or not, that's something that still obviously remains to be seen. And I think it depends on a whole host of different factors, including what the reopening looks like, whether companies continue to seek government support, what does consumer behavior look like, all those types of things. But I think, when you compare it back to the 08-09 crisis, these are two very different crises that we're dealing with. 08-09 was a credit crisis for the banks, and the banks definitely had a liquidity problem at the time. So when you think about it from this time around, this is a health-induced, government-mandated shutdown of the economy. And so that's very different. And both the government and monetary stimulus has been extreme. There's been a lot of support from that perspective. And when you compare back to 08-09, since then, regulation of the banks is way more stringent. And so when you think about it, the tier 1 capital ratios that the banks are required to maintain, that is exactly why they're required to maintain these, so that they can be able to withstand these types of shocks and effects that are coming through right now. So when we look at it right now, the banks are continuing to maintain strong tier 1 capital ratios, and they are still liquid, and they are still open for business. So I think it's definitely very different this time around.
So 08-09, we were really worried about a financial collapse. The banks would go bankrupt, Lehman Brothers, Bear Stearns, etc. Today, you're saying we don't have to worry about it.
I mean, I think everything is always caveated when we talk about anything in COVID, because, it all depends on how long the situation goes on for. I think for now, the governments and, the central banks of the world are certainly, really pumping a lot of support into the economy in order to help continued employment and continued viability of businesses. But of course, there's only a certain amount of time that can go on for, of course, as well. So, the reopening and hopefully the reopening can be successful. And that's going to have a big impact on how long this goes on for and what the different types of measures that need to be taken look like.
Can you raise money today? Can you get debt? Are banks lending?
Yeah, I mean, I think the short answer is yes. I don't think any bank out there is going to say to you, no, we're closed for business. We're not looking to do anything. So, that's kind of the starting point. But I think if you're a borrower right now, some of the important things to consider are, first off, the banks have just taken huge provisions for potential future losses. And so they're going to be very disciplined when it comes to underwriting new credit and where they're going to place their capital. So you can imagine that they're going to scrutinize any sort of new deal activity that they're seeing coming through. And secondly, they're busy. The banks are super, super busy, working on all the stuff that I mentioned earlier, payment deferrals, liquidity for existing clients, covenant amendments, all those things. The bank's credit groups are super busy. And so when you think about that from a new deal perspective, that just means that it's going to take longer to go from, discussion around a deal to an indicative term sheet to a fully underwritten deal. So I think if you're a borrower, definitely take those things into consideration. But yes, there's definitely appetite for new deals. And I mentioned that we're very much open for business, and we are. We actually closed a deal today. So that'll tell you.
Congratulations.
In the midst of COVID, yeah, it's definitely a success story. I think I hate saying this, but everything always gets done on a case-by-case basis. And that is true here as well. We have to look at everything in light of COVID now. I mean, everything has to be really understood in terms of what the impacts of COVID look like on the company, on their, suppliers and on their customers, on the continued viability of all of those kind of parties that operate around the company in terms of their continued feasibility. I think if you're a management team coming to the banks and seeking capital, some of the things that you should do are have strong projections in place and really understand the kind of assumptions behind those, as well as making sure that you're looking at it through different lenses. So having a base case scenario, which is based on a set of assumptions that make sense right now, but maybe sensitizing it, saying, well, what if the reopening is not successful? Or what if my business gets designated as non-essential by the Ontario government, in 3 months' time? Like, what would happen then? And really understanding like the variability of your costs and what sort of, future liquidity could look like in that scenario. I think when you're looking for accessing of capital right now, it's important to over communicate to the banks and really, help them to be a part of the process, because they're going to hone in on due diligence for sure.
I've heard that private debt markets are open and are more attractive than the bank market. Is that true?
I think that the bank market is still definitely liquid, but I think that when you look at the private markets, certainly there's a lot of activity going through that right now too.
Is bank financing more expensive today than it was pre-COVID, or cheaper?
That's a really interesting question, actually, because it's been something that has been absolutely crazy volatile for bankers to deal with as we've been working through COVID. When you think about it, like most of our clients in cash flow lending in the mid-market corporate space, they have variable interest rates, and variable interest rates are made up of a variable component like LIBOR or CDOR, and then a credit spread that's determined based on, bank's cost of funds, the risk rating of the client, the structure of the deal, et cetera, et cetera. And so when COVID hit, central banks all over the world started with their monetary easing and stimulus. And one of the things that happened here was that the benchmark interest rates got cut, and to the tune of around 150 basis points. So that side of the equation reduced, but on the opposite end, there was an inverse relationship between that and what the bank's cost of funds looked like in order for the banks to go out and access market liquidity. And so that component shot up extremely, and it was extremely volatile on an hourly and daily basis, all through kind of March, April, and into early May. It has started to stabilize now, and so it is a little bit easier. And I think when you look at the two components together and on an all-in basis, given the significant reduction in benchmark rates put in place by the government, you're probably looking at an all-in rate that's a little lower now from a client's borrowing perspective. Yeah.
So that's interesting. I had thought that what had happened is that spreads for corporate borrowers had gone up, and that's why the rates were about the same. What you're saying is the actual bank cost of funding had gone up as well.
Yeah, well, it is part of the equation when you look at how banks can, what spread does the bank charge? That's obviously going to be a component of what they can charge, right?
So it's a combination of the bank spread's gone up and the corporate spread's gone up, even though the Bank of Canada rate's gone down.
Yeah, when you look at an all-in rate, which is made up of the components of the variable piece, which is government and central bank induced, and then the opposite side of that is kind of the bank spread that they're going to charge. And there's a few different factors, but yeah, one of the factors is how much it costs the bank to go out and raise liquidity in the market.
We're having a great conversation tonight with Caitriona Gay. Oh, I've got it wrong again here. I apologize. Caitriona Geoghegan, who is head of the lending in the National Client Group at National Bank of Canada. We're going to take a break. Stay with us. Well, welcome back to the Brian Crombie Radio Hour. We're talking bank financing and corporate financing with Caitriona Geoghegan, who is the head of lending in the National Client Group for Central and Western Canada for National Bank of Canada. Caitriona, we've been talking a lot. You said actually the deals are getting closed. You mentioned that the private lending market is open. If you were advising a corporate client right now, would you tell them to come to you or to wait it out and come in a month or two from now when maybe COVID has died down and the market's reopened?
That's a really interesting question, and certainly one that we got asked quite a lot when we came into the first couple of weeks of COVID. I think, going back to the earlier point around how volatile banks' costs of funds were, it was super difficult to price transactions at the start of COVID and into the first month or so of COVID. And so that was definitely one of the reasons why you would advise a client to hold off in terms of, looking at financings that weren't, necessary financings to happen right now. I think now things have definitely stabilized from a cost of funds perspective, but at the same time, there is still, going back to the earlier points around how banks are looking at deals from a very different lens, probably because of COVID and because of all of the different provisions that they've taken at this point. I would say we're always open to looking at transactions and providing advice and telling clients what we think on that case-by-case basis. But certainly, I would say that we're seeing quite a significant volume of deal flow still coming across our desks on a daily basis. And, I think some of this gets impacted by what's happening out there in the M&A world in terms of the amount of deal flow that actually exists from that perspective. And, deal flow in the M&A space is down significantly because there's been this inability for buyers and sellers to meet and conduct their regular due diligence that they always do. And so, that's something that certainly impacts the amount of deal flow that comes into our space. But outside of that, there's also, multiple other kinds of deals that come across our desk, including, well, first of all, there were deals that were on our desks pre-COVID that are continuing to move along. The deals like this don't often close within the space of a couple of weeks. So oftentimes there's a lot of lead time into those. Then there's companies that are out there seeking liquidity, and some of those are maybe a little higher risk, but there's deals coming through, a lot of them through kind of some of the advisors and the accounting firms that are being engaged right now to assist clients in seeking finance. Another one is companies that have deals that are actually refinancing, and where there's a requirement for them to extend their financing, and it's in the middle of COVID. Some of those companies don't have a choice. It's not like as if they can wait another 6 months. If they have a maturity that's upcoming, they need to take care of that right now. I think when we're advising clients around those types of situations, some of the things that are considerations are, what is the tenor of the deal that you're going to put in place? Because where spreads are at right now for different types of transactions, that can have quite a significant impact on the price of a deal, whether it's 1, 2, 3, 4, 5 years, and how to structure the deal as well, on that basis too. So I would say absolutely, we're open for business, and we are always open to providing advice to clients in terms of whether now is the right time, and we'll assess everything on a case by case.
You raised the issue of M&A activity.
Yeah.
Some of the biggest fortunes in history were created by people that were aggressive during crappy times and
Yeah.
made acquisitions, expanded, etc. You go through some of the retailers and some of Carnegie, etc., Rockefeller, Seagram, etc. They were the people that Brofmans that made money in the bad times and were aggressive in the bad times. Do you see people that are out there aggressively looking for acquisitions, or no, it's just dried up completely?
I think, if we talk about it from the start of COVID and on to now, like maybe things are starting to change a little bit now. I think for the first 2 months, things definitely dried up. Like, I think when you look at the US, deal flow declined by like 50%, in Q1. And that's probably even lower now when you're coming into Q2. But when you look at the players in the M&A industry, like who are the ones that are out there buying and selling companies? The strategics that will be out there buying and selling companies are trying to take care of their own companies and how to navigate through this whole COVID situation. And then outside of that, you've got PE firms who are also doing the same thing. They're trying to figure out, where are my portfolio companies at? How can I manage through that? Maybe I need to set aside some capital to actually, manage my existing portfolio of companies. And as well, travel restrictions, especially between Canada and the US, a lot of deal flow comes into Canada from US sponsors too. So all of those things meant that deal activity really came to a halt. But there are still some transactions happening. And, as I mentioned, we closed a financing today, and that was something that was in the M&A space. In the space which is not being impacted as severely by COVID. And so obviously that makes a difference. But outside of that, there's a lot of challenges still. There will be opportunities, I think, to your point, like lots of investors will be interested to see if they can get a good deal out of industries that are, experiencing significant turmoil right now. So that for sure will be the case. And you're going to see folks trying to deploy capital as well as we start to come out of this too. And the reopening of the economy will probably see an increase in the amount of deal activity. There's going to be some implications too, though, because of social distancing. There's going to be, will people be willing to travel? Well, like there's always a component of travel when you're looking at a deal flow. Will people be willing to travel commercial, or will it now be more kind of executive level people that are going on corporate jets to visit with the potential suitors? Is that something that will happen? Or will people maybe use strategic networks in some of the jurisdictions in which they're looking to invest in order to help them get deals across the line, whether that's, lawyers or accountants or advisors of some sort that they have as a trusted partner in terms of looking at, activity where they can't themselves be there. Or, maybe there's going to be more localized deal flow as well, just given the inability for travel to be quite as strong as it would have been in the past. And I say all of this not knowing what actually is going to happen. And, of course, it's all going to come down to whether we can reopen and whether a vaccine happens and all of that stuff. But I think it all remains to be seen.
I've heard a couple of announcements of people raising distressed debt funds. Do you think there's going to be an opportunity to either buy debt cheaply and or frankly buy companies through the debt?
I think that it's an interesting phenomenon, and obviously it's something that we'll see what happens. I haven't had a lot of experience in working with that stuff as of yet, but certainly something that I'd be interested to keep an eye on.
What about equity markets? I know you don't cover the equity markets, but some of the members of the panel that you moderated had
Yeah.
comments on the equity markets. Are they open for business?
Yeah, I think the panel that you saw, the equity participant from that perspective was a private equity investor, Clearspring Capital Partners, and they very much were of the opinion at that point, and things change so fluidly, of course, but at that stage, what they were doing was really managing through their existing portfolio of companies and ensuring that they were, taking care of the impacts of COVID on those. They had mentioned the fact that there was a very significant pipeline coming into COVID. And so some of the transactions did get put on hold for different considerations, one way or the other. And so more than likely, private equity companies like that will see some of that deal flow come back online at some point. I was talking with another person within the private equity landscape there this week, and they were mentioning that their expectation was that things would start to reopen probably post Labor Day. Maybe that's a little far-reaching, I don't know, but from an equity investment standpoint, I think a lot of it lines up with what the banks are saying in terms of their investing or us financing. I mean, it's the same types of thought processes that you're going through in terms of, have you taken care of your existing book of business? And now have you got, a capacity and an appetite to actually go out there and do new business? So I think the same thing applies from that perspective.
Maybe I can ask you about a couple of industries. So, I interviewed a guy that was the president of the Canadian Automotive Parts Manufacturing Association, and he said global supply chains are a thing of the past. We're going to be nationalizing things dramatically, and so all my members are got to start thinking about how they operate with not no global supply, but far less global supply logistics in the future. Yeah. Is that an issue? Do you think it's going to change? And how does that impact your interest in lending to those companies?
I think supply chains will definitely be impacted by COVID. And it already was probably one of the first things that we saw get impacted when COVID hit. Because, we're North American based companies that we're generally dealing with. But a lot of our companies started to see the impacts of COVID at the end of 2019 and into Q1 because of the fact that they had supply chains coming from China, which is where COVID obviously started out. And we saw, I think COVID really exposed the vulnerabilities of a lot of companies that had, so much dependence on one specific country for their supply. And I think coming out of COVID, we're going to see a lot of diversification of that, at least coming out of COVID and the impacts that have happened from that perspective. Probably it'll be the case that firms diversify their supply chain while still trying to maintain some level of cost control. So maybe we'll start to see, other manufacturing hubs such as, Vietnam or Mexico or even India that are like, they're likely to see some benefit out of companies diversifying away from only China, for example. I think as well, we'll probably see a switch to more vertical integration where that's, an option for companies, or domestic sourcing, to your point, which if that is an option to try and offset some of the impacts of sourcing internationally. And I mean, COVID isn't the only thing that is impacting supply chains. There have been lots of other considerations in terms of global trade over the past number of years, with a certain president down south. So lots of different things that have been impacting global trade over the past few years, now kind of accentuated by the COVID restrictions too.
What about regional malls? Number one, we've opened up stores on street fronts, but we haven't yet opened up stores in the regional malls. What's going to happen? You think about some of these stores in all these malls, are they going to survive? And then what about the landlords themselves? I just interviewed a guy by the name of Ken Greenberg, who is one of the top urban thinkers in Canada. And he said regional malls were suffering to start with, but now they're going to be killed.
Yeah, I mean, obviously storefront only has been open for now, given, social distancing restrictions. The longer that this phase of the reopening is not happening, the longer that these companies are going without any sort of cash flow and, without an ability to service their customers through an online channel, some of these companies may not come through on the other side. And retail was already so, challenged, really before COVID even hit. I think when you look at regional malls, I think that how long it takes for things to reopen will be an impact, and how what consumer patterns look like when things reopen. Like, I think when you look at some countries, like when you look at China, for example, China reopened their economy, but even though everything is reopened, spending and consumer patterns are not back in line with where they were. Like, consumer footfall is at 50% still. So that goes to show you that, it's not just because of a government mandated shutdown that people will not go out and spend and do things. Some of that is maybe a fear of contracting the virus. And maybe some of that will continue to be the case until we see some sort of a vaccine put in place. And that could take a long time, obviously. But I mean, generally speaking, I think some of the challenges that retail brick and mortar have seen over the past few years have certainly been accentuated by COVID, and perhaps that continues to ramp up and force the rethinking of that industry into a more of an online model. I think a lot of people have been saying that technology has leaped forward very significantly through COVID, and it's true. Like, I mean, some companies have been saying that they've done 2 months. In 2 months, they've done 2 years worth of technology roadmap. I think necessity is obviously the mother of invention. We always say that on our team, and it certainly is true. And people have had to just figure it out. And even going back to the whole work from home thing, when people get a taste of how things can be more efficient in different types of scenarios, maybe that really changes things. I think COVID in general is going to really change the way that businesses and people do things in general.
Well, so let's talk about that. I went down to get some files out of my office at Bay and Front last week, and no one was around. It was like the zombie apocalypse. I was just walking around, and I presume you're in the office building at York and King.
Yes.
I walked around that sector, and I maybe saw at lunchtime where I would have seen typically thousands of people. I saw maybe a dozen of people. Shopify, Facebook, Google, lots of companies have said they're not going to go back to offices. They're going to allow their employees to work from home. Would you lend to the big office companies, the big commercial landlords right now?
I think, just like every other business, those businesses are going to have to figure out a way to pivot through COVID as well. So, I mean, do we go to a place where there's absolutely nobody working in offices anymore? That's probably on the complete opposite end of the spectrum than where we're at right now. I think that these landlords will be impacted, of course, and maybe they're going to have to pivot away from the types of customers that they have within their facilities and buildings right now, maybe into some more sort of residential type offerings or such like. But I think it'll be a wait and see again in terms of how long this goes on for and how much change happens within kind of the office workspace environment. We within National Bank, like we are all working from home very comfortably, and I don't see, I mean, this is not our formal opinion, but I don't see us all going back to working in the office for a very long time. But I imagine that there's going to be some reintroduction across different teams, depending on the amount of people that can be on the floor at any given point. There's other implications to the whole work from home than just, the efficiency of not going into the office. And, I've heard from some people that in some of the office towers downtown that it could take up to 3 hours to get up with social distancing on elevators, depending on which floor you're on. So those types of things are obviously going to be a hindrance, and people are not going to want to be, wasting their time and taking big chunks out of their day in terms of trying to just get into the office and do work. But outside of that, there's also this kind of social aspect and team aspect of being part of an organization and having social interactions with people. So, maybe there's a balance. Maybe it's the case that we have a certain proportion of people working from home offices for certain parts of the week, and maybe it's kind of a 1 or 2 or 3 day week in the office and people are circulating or something like that. I mean, it'll all be, we'll figure it out over time, but I think there's lots of change. But, do we go from having absolutely no people working in offices? I'm not sure that would happen either.
We're chatting tonight with Caitriona Geoghegan, head of the lending for the National Client Group of National Bank. Stay with us. Welcome back to the Brian Crombie Radio Hour. We've been having, I think, an interesting conversation with Caitriona Geoghegan, head of lending in National Bank for Diversified Industries. You're from Ireland.
I am.
Excellent. So, we've been talking about COVID-19 and bank lending primarily, but one of the other big things that's happened in the world, and it's almost forgotten because of riots in the United States and COVID-19, but is Brexit. And, the United Kingdom, Great Britain leaving the European Union. What's the impact going to be on either the United Kingdom or Ireland, for that matter, of the divorce from the EU? Any opinion?
I mean, I think, generally speaking, the UK is Ireland's largest trading partner, and so it certainly is going to be extremely impactful on Ireland in terms of trade, and depending on, and there's still lots of different nuances to the agreements that are going to get put in place around all of that, but that's certainly something that's going to be impactful. I think when you look at Ireland, relatively speaking, as an investment hub in Europe, outside of the UK, Ireland is one of the only English-speaking countries, and it's when we look at it, Ireland and Canada treaties that are in place, Ireland and Canada have common law, common language. And so it's definitely one of the considerations when investing in international operations. So, I think we've seen lots of banks and lots of large kind of, call it international to Ireland companies, relocating their offices out of the UK and into Ireland. So that for sure will be a positive, but I don't think that on an overall basis that will be enough to offset some of the impacts of the trade that can happen between the two countries. Obviously, there's the whole border wall issue as well between Northern Ireland and the Republic of Ireland. And I know that, there's lots of discussions happening around what that all looks like. And, it brings up different types of memories for people around, some of the troubles that happened back in Ireland back in the day as well. So there's lots of different considerations outside of the economic piece of it as well.
What do you think is going to happen with Northern Ireland versus Ireland? I think that some people were saying that they had to have the free flow of goods and non-tariffs. And yet, I don't know how you do that if Northern Ireland is no longer part of the EU.
Yeah, and I think it comes down to what actually gets agreed upon between the two. I think having a border wall and putting in place something very separate as between the two is probably the wrong decision for trade, if nothing else. And I think it could cause other issues outside of trade too. But generally speaking, I think that Brexit is something that will be more impactful between, Britain and Ireland proper, as opposed to Northern and Southern Ireland. And I think that that's because when the agreements get finalized between the two, they're going to have to figure something out in terms of making sure that trade can continue between the two.
You've lived there. You were born there, I presume. Why do you think Britain was against the EU? And Ireland and Scotland were for it?
I mean, that's a that's a very difficult question to answer. I mean, I think part of it is probably to do with a pride thing from England's perspective in terms of wanting to have their own ability to make their own laws and their own rules and not to be answering to a higher power in the EU. Ireland and Scotland certainly saw the benefits of being a part of this kind of broader economic kind of landscape, and certainly something that as a citizen of Ireland, for me in particular, you have access to all of the countries within the EU, in being a member state within the EU, and you have access to all of the different, programs and support and all of that. Going back to the 08-09 recession, I think, there was a lot of support that came through from the EU in terms of the member countries as well. And so, why the UK didn't want to be a part of that? I mean, it's hard to say why that is the case, but it's probably something to do with the fact that they wanted to have their own ability to make their own rules.
The Ireland sort of succeeded for quite a while based on a low tax strategy. Ontario instituted a low tax strategy, and then Trump reduced taxes dramatically. And it's almost this zero, it's race to the lowest of tax. Can you have and be successful as a country with a low tax strategy anymore?
I mean, Ireland has been extremely successful in terms of their low tax strategy, and given like Ireland is a small country on an island, and it requires foreign direct investment in order to be successful in terms of boosting the economy. And so instituting the 12.5% tax rate is something that really brought a lot of foreign direct investment into the country. And there's different types of implications, of course, in terms of companies having their head offices in Ireland. And certainly that's something that has evolved over time in terms of what sort of a presence you need to have there in terms of having access to that rate. It can't anymore just be kind of a shell office, which may or may not have been the case in the past. But I think generally speaking, the low tax rate is something that was certainly successful for Ireland in terms of boosting the economy. So yeah, I think from that perspective, it definitely is something that that can be a success.
My son just graduated from university with an MBA, wants to get into banking. He's got EU citizenship, American citizenship, Canadian citizenship. He could go and work in each one of these countries that you've worked in. He wants to get into banking. What would you tell a young person graduating today? Where can you best make your future in banking?
It's interesting to be coming out of university right now because, who knows what kind of the hiring landscape looks like right now. But I think certainly, entering into, when I go back to where I started out, I joined an Irish bank in Dublin back in 2007. And it was about 1 year before everything went, I don't want to say anything bad, but it went that way. and certainly I felt as though it was probably good timing to get into the workforce at that point. And it was a bit of a baptism by fire in terms of, getting into the banking environment. But it was a great grounding, and it's a great grounding to be, and I say this to the associates on our team, it's a really good time for learning, to be a part of this whole recession and downturn in terms of how to assess credit and really understand how to structure deals and put money out the door from a bank's point of view. So being a part of an institution at this time, you just learn so much. I think getting into a corporate commercial banking role as an underwriter and really learning the ropes is a great place to start out, and that's what I did. And
but where? Dublin, Toronto?
Oh, where? Sorry.
Dublin, Toronto, or New York?
They all have their good points, I think. Where do we feel that the most stability will be over the next couple of years entering into a bank right now? I think the Canadian banks are very well capitalized, and they would probably be a good place to start out your career. So yeah, I'd probably say Canada.
Caitriona Geoghegan, thank you so much for joining us from National Bank of Canada. Really appreciate your thoughts. This was a very thorough conversation about the markets, and thank you so much.
Thank you so much for having me. It was a pleasure.
Well, that's the Brian Crombie Radio Hour for tonight. We're talking about the debt markets and effectively bottom line. I think Caitriona said it, cash is king. So you want to make sure that you take care of your liquidity, that you got some cash. She talks about making sure that you can get through those covenants, and lots of people are doing covenant amendments. And so you got to do that. And then I think the answer also is that tough times, companies are cheap, and now's the time to actually think about expansion. And if you got a cooperative, helpful banker that's going to support you, that's the time to go out and buy. Too many people want to buy when the market's at the high. Don't only buy when the market's high. That's when you should be selling. Time to buy is when the market's at the low. And there's going to be companies that are available at attractive prices right now, and you just got to go and get the money from Caitriona. Maybe that's my idea. Have a great night, everybody. Thanks for joining us. Bye-bye.